All right. I want to talk about the moving average, the sheer power of the moving average.
Well, oh, it must have been an accident.
All right, moving averages.
All right.
I got the concept from Oliver Velez, and there are basically multiple ways you can utilize them. I use moving averages, I guess, for two basic scenarios, right? Um, More so now, I use the 9 and the 13 because we have a lot of trend trades, right? And the 9 and the 13 period moving average allows you to stay on the right side of the trend, right? You can use, um, you can tighten up. You can use smaller moving averages for steeper trends, or you can use uh, larger moving averages for trends that aren't so steep. So if we look at this chart, uh, when Bitcoin had that meteoric rise, um, we could have probably used a 5 and a 7, right? So let me look at this 5 and 7 real fast. So if we use the 5 and 7, it allows us to get better entries whenever price, touches the moving average, right? And the steeper the trend, the more tight, the lower numbers you want to use for the moving average. The smaller moving average is always going to be your green line. You're going to have those numbers and lines green. The higher number, you want the numbers and lines to be red, right? Because they're going to act as a signal line, right? So if the green is on top, that means we're buying. And then the crossover, the red will be on top. It means we're selling, right? It's important for everybody to understand that these moving averages are lag indicators, which means that the pair is already going to be selling by the time that the moving average signals for you to sell, right? But you can still use them to make money. So if you notice down here, we get a bullish order block. We start buying the indicator, or you don't get this. Well, actually, we get a bullish order block here. Price is beneath the moving average. If you buy it, you go into drawdown, maybe even blow your account right here. But you get another bullish order block. Your moving average is still below the price, right? If you get in this trade here, you're buying, the signal crosses over right here at the start of this green candle, and you just buy it all the way up, right? And every time that price sells, it'll sell into the moving average. Then it'll go up. When you get the retracement, it retraces into the moving average. It goes up. The retracement into the moving average. Price goes up, right? So this allows you to kind of use that moving average as an entry point because you're not getting any bearish order blocks, right? You're just getting a retracement wick into the moving average, and then it buys up. Everybody tracking? So, can y'all hear me?
Mm-hmm.
Okay. So if we look at the other side, when price starts going down on a meteoric crash here, it's the same thing. You get a sell down, you get a retracement into the moving average, you get a sell down, retracement close to the moving average, you get a sell down, and then it retraces to the moving average, and you get a sell down again. Now, price is at the moving average, and you got a bearish order block. We can sell this down. I created this chart a while back, right? And when price gets down here, I'm going to buy Bitcoin. because this is a pullback. That's all price is doing is pulling back. And I know this takes years. Like this is 2020. And now we're in 2022. But price is going to pull back into this supply zone right here. Or demand zone right here. And then it'll go back up. But it'll be interesting to see it. So that's how you use the moving averages for, I mean, that's how I've been using them lately, right? There's another method of the moving average that you can use, and that's the 20 period moving average and the 200 period moving average. Let me see. I used to trade with these all the time, and when I was doing support and resistance, and that we call it the dumb money trading. We weren't using the smart money concept. We were using support resistance, a lot less reliable information, in my opinion. So basically, there's this concept that Oliver Velez uses, which is called the picture of power, right? The picture of power is when price and the moving averages are in close proximity to each other, right? They can be touching or they can just be very, very close. I want to move down to a lower time frame where we can see a continuous line, okay? So if you look right through here, price and the moving average, both moving averages are all together. I'm going to spread this chart out so we can see. As this green moving averages crosses the red, again, the green means buy, the red means sell. If the green is on top, we're buying. If the red is on top, you're selling. That's the concept, at least, right? The green crosses over, so we're buying. But this crossover right here is really a signal for price already crosses over right here. The line doesn't cross over for 1, 2, 3, 4, 5, 6, 7, 8, 9, like 10 days, 12 days. Price crosses over. 12 days later, you get the signal. You see that? So it's not as reliable as us looking and saying, okay, we got a bullish order block, right? Or we got a bearish order block. So we think that if you use smart money concepts, there's nothing wrong with using the moving averages as confluence. But the picture of power is when price is on top of the moving average, of the 20 period moving average, and the 20 period moving average is on top of the 200 period moving average, you have the picture of power to the top side. And when you get a picture of power to the top side, what Oliver Velez teaches is that price can cascade in that direction. So you got the picture of power here, and it really didn't do anything. Price came back and touched the moving average. Then it went up again, which would have been a pretty strong indication to me that this price was just trying to break out and we were going to get a cascade event. But if you had just hung in there with the buy, even though we crossed back over here, it never hit the movie, it never hit the 200. Eventually you get your cascade to the upside. Does that make sense? Yes. So at some point, price was way up here, right? Then the price and both moving averages come back together. You get this strong bearish candle that crosses over the 200, and the signal crosses over the 200. Now you have price below the 20 period moving average, excuse me, and the 20 period moving average below the 200. So you'll get a cascading event to the downside. And if you just trade, that system, you can be successful doing it. It's just you're not going to be as accurate as you are just trading the order blocks, right? but you can still use this information for confluence on your charts, right? So if you were doing an analysis, let's say you wanted to trade NU, right? And you saw an order block close to this moving average, right? You get rejection here, you get a bearish move, you know you're sitting on top of the 200 period moving average, you can probably have a good sense that price is going to push down, right? And because this is a daily chart, because this down move is going to paint the picture of power, you can probably assume that you're going to have a pretty big move to the downside, right? Just based on how the moving averages in the charts are set up. It would be the same thing going to the other side if you get one going to the other side. So you get a bullish order block right here, and it closes right here beneath your moving average. I can anticipate that we're going to push through this moving average. And when we push through this moving average, it's going to give me a picture of power to the top side, and I'll get a cascade move going up. You guys have any questions? No questions?
So you just got to find the picture of power on the daily, or
well, you know, whatever
the weekly on GM. So.
Whatever time frame you're using is fine, right? If you trade that time frame in that picture of power, you're going to get a cascading move on that time frame. So naturally, the higher time frame that you find that the picture of power on, you're going to have a bigger move. You know, I really feel like we do perfectly fine when it comes to a pip count. You know, I don't ever use this for my weekly analysis. I used to, but I don't use it at this point on my weekly analysis. I much rather rely on my higher time frame order blocks, and then use the 9 and the 13 for my trend. You know, like, so we can clearly see how price interacts with that trend. I think I've found a great deal of success. I don't struggle trying to find trade setups doing it that way. I'm not telling you shouldn't use it or you can't use it. I mean, it's still useful information, but I just don't ever do it anymore. You know, on the weekly, you know, maybe.
So is this the 9 and 13 or still the 20?
No, this is still 20 and 200. But if you're going to,
you don't use this anymore.
I don't know, no. But I'm just showing you that it can be useful if you choose to use it like that. So on this weekly, like, we would have traded this order block up right here, but you might have said to yourself, it's going to be a cascade move because we're breaking through the 200 period moving average. That is useful information. But the fact is, you take in so much information as a trader that, you know, you kind of don't have time to utilize it all. You know, I can't use every tactic that I've ever learned on the internet. You know, I use what works for me now, and, you know, I'm cool with that. But if you are having problems seeing moves as a trader, this might be a concept that works for you. Or, you know, these tools might be tools that work for you. You know, they worked for me when I use them. I've just kind of evolved into looking at the market from a different standpoint, right? In my opinion, you know, like, the monthly order block will give you cascading moves too. So I don't have to rely on a moving average to tell me, you know, when we're going to go higher or lower, you know. But you can you can definitely use that to help you with your analysis if you need to.
Yeah.
You guys have any questions?
Can you show us the 9 and 13, please? Like, GM.
You said, can I show you the 9 and 13?
Yeah. How you explain it when you're talking about the GM trade and stuff, and how you use it from the weekly to the smaller time.
Yeah.
What color is the 9 supposed to be? Anyone? Anyone? What color is the 13 supposed to be?
Red.
Okay, the lower number is always going to be green, right? And the higher number is always going to be red, right? Because they're going to signal the trader that it's time to buy or sell. Whichever one is on top, that's technically what we should be doing. So if the red line is on top, we should be selling. And if the green line is on top, we should be buying. So whenever we get these moving averages, you see how this moving average is running right through the middle of this pair.
Mm-hmm.
In my opinion, this is not as helpful as it could be. I need to widen that range because I want the moving average to run. I want the pair to come back and touch it. I don't want it to keep going through it, right? So maybe I need to use a 13 and 15, I don't know. But I'll just keep playing with these numbers on this particular pair right here. 13. And the reason why you have to do this is because this is not really trending in any particular direction. On a pair that's actually moving up or moving down, you're going to see these moving averages like right through here. Price is above it, it'll just come back and touch it, and it bounces off the moving average. That's what you want from your moving average. If you have price that's moving right through the middle of your moving averages, it's really not assisting you. You're not getting any value out of this moving average. So you got to adjust these numbers, and this is probably the correct adjustment for right now, because we're getting, as this pair falls, you're getting more of a come back and touch and then fall, come back and touch and then fall. So you want the moving average to act as either resistance on a sell or support on a buy. Yes, ma'am, Alicia.
Is there a specific increment that you adjust the moving averages by, or maybe by increments of 5, or you just until you get that bounce from?
You have to adjust them until you get the bounce. You're not going to know when you first start doing this how high or how low you need to adjust them. But the more steep the trend is, or the more aggressive the trend is, the lower the numbers you'll have to use. And the less steep the trend is, the softer or the higher the numbers you need to use. And you just adjust them until you get a pattern. It's like, you notice I didn't adjust the numbers where they go above the top of this one, but this last touch worked, and now it's kind of touching again. So that tells me that the adjustment is good. So now if it falls down, that will work or if it pushes through, I just needed to come back and touch the moving average and keep going. That makes sense?
Yes, it does.
What else? Anyone? Do you guys find value in the moving average?
This is a method of adding extra confluence.
What's that?
Just as a method of adding extra confluence to when you're trading, or like a cushion to just backtrack, making sure that you're on the right track.
Yeah, I think that you know, if you're going to use these, I think that most of the time you're going to have to do it for a few weeks, right? And then it'll start making more sense. If you just look at these on somebody else's charts and you never put them on your own chart, it probably won't make as much sense. But you know, like I kind of use these so much that on my analysis, you know, I can see exactly what I need to see, you know, based on where price is, you know, with the moving average involved, right? That's why I'm always skeptical of buying a bullish order block that's beneath the moving average, because you can get a bullish order block and price can go right, like this bullish order block. You see that bullish order block? So I'm not trying to buy this bullish order block because it's right at the moving average. And the next thing that happens is you get a bigger bearish candle, right? So instead of getting caught up, you know, in saying that the order block system doesn't work, it's easier to look at why would this give you a bullish order block and then immediately sell? And the answer is it had to give you a bullish order block to get back to the moving averages. The trend is still a bearish trend. So you should have expected, as a trader, you should expect it to reject from that moving average and push further to the downside. These types of nuances will save you a lot of heartache, you know, when it comes to trading. And, you know, you're going to have to write all of this stuff down and keep it like in a notebook besides whatever you trade. You know, like if you trade on a laptop, you know, make you a little notebook of your rules on your laptop. And then maybe every time you learn a little nuances you can use, write that down. You know, maybe it's not a rule, but it's something else you can use for confluence, right? And a lot of times, if you see a bullish order block here, instead of being anxious to hop in this trade, you'll say, you know, this is a lower high, like it didn't break this high. It's sitting at the moving average. I'm either going to sell it down to this order block, or I'm just going to sell it because I know it's going to push further down, right? But that's why when I trade these weekly order blocks, I'm so adamant about selling to buy or buying to sell, because as long as you get in the trade and you go with that move, if it violates that order block, you're still going to be making money, right? You're not going to lose your money. Make sense?
Yeah, that makes sense. Thank you. Good explanation.
It's those potatoes that was in there. I'm gonna clean that thing up. It was rotten.
I need to see how it works with the order blocks, and you just explained that, so that's good.
That piece of potatoes been rotten, but they didn't have a trash can. I probably should have put them outside.
That's not boring.
Cause I just like that floor. It was leaking.
Here's some order blocks next to your moving average. But you see how your moving averages are sagging right here? You need to move it closer. So if they're sagging, then you're going to have to use a lower number. And this is where you come and probably put it back to the 9 and 13.
So what does the sagging mean then of the lines?
So look, I adjusted this one. See how when I use a smaller number, price is reacting at the line. If you
Yeah,
use a bigger number, price is not reacting at the line. Is not you're not gaining any advantage by using this bigger number.
okay.
You want to tighten it up. So you want to use a smaller number so that price can react with your moving average. So remember on strong trends, you need to use smaller numbers. So your price is going to bounce off a tighter moving average. See, on this moving average, we actually got 1, 2, 3 bounces. With that other one, we only had 1 bounce, you know. So you want to use the moving average that your trend is actually following, right? So this moving average, you got a bounce here, it goes through, but it sells right back down. You get a bounce here, then it breaks through again, but this is a chalk move, right? And then you change your direction and you get these bounces. So you just want to pay attention to how price is reacting with your moving average. If it's going right through the middle, then that means you need to use a larger number. If it's too high up here or it's too low over here, that means it's sagging. You need to use a lower number.
Okay.
Everybody tracking?
Yes.
All right, what else?
So do you only use it on the higher time frames then? Do you go down to the 15-minute or the
Use it on any time frame. But
and have the same confluence
yeah,
like you're saying on this daily? Yeah, we do it first.
yep, same I mean, you guys notice when we look at the charts, from my computer at least, they're on whatever time frame I select, right? Like this is the 9 and 13. It interacts beautifully with the trend here. So this is the 4-hour chart. I kind of want to keep stressing to you guys, if you're on this swing traders call, you know, we want to stay with the higher time frames. You know, we want to find our setup on the weekly. We want to execute our trade and manage our trade from the 4-hour. That's going to keep us safe at our skill level right now. As you find success on this level, then there's always opportunity to trade retracements and things from the lower time frame. But the problem when you start using other time frames, whether they're the daily or the 8-hour or the 6-hour, is you can get caught up, you know, in those other order blocks, and you lose focus on the important things. So the important things are the weekly order block is going to give us the direction. The 4-hour order block is going to allow us to manage the trade into the direction that the weekly order block is going, right? If we're confused about the weekly order block, right, which we shouldn't be, but if we're ever confused about an order block, this is a weekly order block that it says buy, okay? This weekly order block is above our moving averages, so we have nothing to fear here. But if this weekly order block was below the moving averages, now we can't just close our eyes and buy here. We have to ask ourselves, is this weekly order block that says buy, is it actually going to buy, or is it at the trend line and it's going to push down? You know, so you can't just arbitrarily jump into these bullish order blocks that end at the trend, right? We still have to keep in mind what the actual trend is for the before we hop in these order blocks and take them whatever direction we think they're running. Everybody tracking?
Yes. And just to confirm, you said that when it crosses over is the same thing, same indication of like a change of trend when they cross over?
Yes, there's yes. When it crosses over and closes, right? We can assume that this is going to go up. So if you had got in this trade right here and this pushed up, hopefully you would have taken your profit, right? Or when you saw it retracing, hopefully you just didn't watch it all go back to the banker, to your broker. You could have gotten out. But the bottom line is, if you're trading and the order block is at the moving average, you need to look for confirmation of this actually being a buy. And the best way to do that is sell this candle into the order block itself. That's the best way you can protect yourself as a trader. If you had a bullish order block that's beneath the moving average, you got to sell that next candle into the order block. That's why on this weekly, when we take our weekly trades, we always do the opposite of what the order block says do first. That's the first thing we do. Is if we were taking this trade for the week, we're going to sell it first and then buy it. If you notice, this is not even an order block, but you see how many pips that the US 30 ran, right? This huge candle right here, 18,000 pips. So the first thing you do as a trader when the market opens is you sell it back down, right? You know it's going to buy, but the first thing you have to do is you got to sell it in order to benefit from that sell. If you just jumped in here for a buy, you're going to lose a lot of money.
And is there any importance or relevance of when the moving averages cross over each other? Like when you mentioned about the 20 and the 200, that there was some significance.
So
is that the same with this?
Okay, that's a good question. So the 20 and 200, I explained to you the picture of power. But when you use these tighter moving averages, the only significance is you'll have a green over a red, or you'll have a red over a green. And that's supposed to indicate whether you're buying or selling. When the green crosses over the red, in theory, you should be buying. When the red crosses over the green, in theory, you should be selling. Does that make sense?
Okay, yeah. Yes, it does.
Okay. I would really caution against relying on those as the signal solely, right? And the reason being is because it's a lag indicator. If you notice, you get this bullish order block that closes. This next order block is going to buy, but you don't get a signal for just 2 more weeks. This is a weekly candle. You can't wait 2 weeks. You can't wait 2 candles in order to get into this buy, because as soon as you get the signal to buy, guess what happens? It sells. You know what I'm saying? So we don't really have to worry about this because we trade smart money concepts, which is the order blocks. We don't use these for signals to buy and sell. We use them for proximity on the chart. Like, where are we on this chart? Are we close to the moving averages, or are we far away from the moving average? Do I have to worry about this order block being a decoy, or can I trade this order block like it's a real order block? Like, is it really crossing over the moving averages? Everybody understand that?
Yes, sir.
Anybody want to see anything else?
Yeah, that was good. Thank you.
Awesome.
Anybody?
Hey, Lynn, this trade right here is going to look like it's going to sell. It's going to be a good one.
Gotcha. I'll check it out. Thank you.
All righty then. Let me stop this recording.